Welcome to Talk Tickers. We're here to give you the shortcut, the inside track on important earnings calls.
Think of us as your cheat sheet. We pull out what really matters.
Exactly. So today we're diving into the latest call from this company. We'll break down the key numbers, what management said, and try to figure out what it all means.
So kicking things off, the first quarter looked like a pretty solid start to the year.
Okay. What are the headline numbers?
Net income hit $63.2 million. That works out to $1.16 per diluted share.
And pre-provision?
Pre-provision net revenue was $85.7 million.
Yeah.
That's kind of their core operating profit before loan loss provisions.
Got it. And returns?
Return on average assets, 1.45%, and return on common equity came in at 15.6%. Pretty decent numbers.
Okay, let's unpack that net income a bit. $63.2 million. How does that compare?
Well, compared to the same time last year, it's up significantly, over $13 million higher, which is, a 26% jump year over year.
Wow, okay. But wasn't it down slightly from the last quarter, Q4?
It was, yeah. Down about $2 million, around 3%. But they flagged that was mainly due to just fewer days in Q1.
Right, the
calendar, and also some shifts in their effective tax rate. So not necessarily a performance dip in the core business.
Makes sense. Okay, let's dig deeper. What about loan growth? That's always key.
Absolutely. And it was strong. They reported 9% annualized growth net of payoffs.
9% net. That's pretty robust.
It is. And interestingly, their loan pipeline, so potential future deals, is actually up 10% just since January.
Suggesting momentum could continue then.
That seems to be the implication, yeah. And it wasn't just one type of loan. They said the growth was broad-based across the portfolio.
Okay, good to hear. What about the other side of the balance sheet deposits?
Also, strong growth there in Q1, which, as you know, can be a bit unusual for the first quarter.
Right, usually see outflows sometimes. What drove the increase?
Primarily municipal deposits and correspondent banking deposits. Seems like it was linked to government funds moving through the system.
Ah, okay, so maybe not entirely core, stable funding.
Well, they did mention they exited most of their, let's call them non-core deposit relationships back in Q1 of last year.
Ah, okay. Cleaning things up.
Exactly. And these correspondent balances, while they surged in Q1, have apparently leveled off since then.
Got it. So maybe a temporary boost that's now normalizing. Anything on expansion, new markets?
Yeah, they mentioned adding 4 new producers, new landers in the first quarter.
Okay.
And they're apparently in talks, exploring several potential new markets for expansion later this year.
So pushing for organic growth still. Let's switch gears to credit quality. How are things looking there?
Charge-offs were at an annualized rate of 19 basis points, so 0.19%.
How does that compare?
It's higher than the last few quarters, definitely. But management framed it as being more in line with pre-pandemic levels, a return to normal, basically.
And what were those charge-offs related to? Anything systemic?
They indicated it was largely tied to loans that were already identified as impaired, so older issues working their way through.
Okay. What about the allowance, the reserves they set aside?
The allowance for loan losses grew in dollar terms, which makes sense with loan growth.
Right.
But as a percentage of total loans, it actually ticked down slightly, from 1.30% to 1.28%.
Interesting. Less cushion relative to the portfolio size, even if the dollar amount is up?
A little bit, yeah. Also, non-performing assets increased.
Oh. By how much? And what's in there?
The increase.
Yeah.
About 70% of it, they said, was linked to just 2 specific commercial real estate relationships. Secured loans, but in different markets.
2 specific loans driving most of the increase.
Okay.
Does that worry you, that concentration?
It's something to watch for sure. But on the flip side, OREO, the property they actually own from foreclosure, that decreased significantly. So they're resolving some older issues.
Fair point. Okay. Overall size, asset growth.
Big growth there. Total assets grew by almost $1.3 billion just since year end.
Wow.
Reaching $18.6 billion. That's up 7% since December 31st and 19% year over year.
The 19% year over year growth is substantial. Where did that growth come from?
Well, we talked about the loan growth.
Yeah.
But also their cash balances held at the Federal Reserve grew significantly.
Holding more cash. Okay. Let's talk profitability drivers then. Net interest income.
Came in at $123.5 million. That's up a solid $21 million from Q1 last year.
Good.
And slightly higher than Q4 as well. But, and this is important, the net interest margin, the percentage, was diluted.
Because of that extra cash sitting at the Fed,
Right.
Earning very little.
Exactly. That higher cash balance dragged the NIM down.
Do they expect that cash to stick around?
They seem to anticipate deploying it. They also gave some forward-looking numbers. Over the next year, they expect about $1.5 billion in cash flow from fixed-rate loans maturing.
At what kind of rate?
Average rate of 4.76%, plus another $100 million in mortgage-backed securities paydowns, though those are at a lower average rate, about 2.5%.
Okay, so cash coming in from the existing book.
Right. And they also projected over $1.9 billion in assets repricing over the next 12 months. That's a big chunk that could potentially move to higher current rates.
That's definitely an opportunity for future NII, depending on where rates go. What about the provision expense for potential losses?
Provision was $6.6 million for the quarter. That was up from last year and last quarter.
Why the increase? Just loan growth?
Mostly, yes. But also, there was a factor related to unwinding a reserve they'd set up for potential hurricane losses, which never actually materialized, so they released that reserve, but the underlying provision needed for the loan growth still pushed the total figure up slightly.
Got it. Okay. Outside of interest income fees and other income?
Non-interest income is actually down about 7% year over year.
Any reason?
Yeah, apparently there was a one-time benefit in Q1 of last year. If you strip that out, they said non-interest income actually increased by about 7%.
Okay, so underlying trend is positive. What's driving that?
Mainly higher service charges on deposit accounts. It was down a bit compared to Q4, but again, fewer days, seasonal stuff.
Yeah.
They expected to pick back up in Q2.
Right. Now, expenses. Always a focus. Non-interest expense.
This is interesting. It was actually down compared to Q4 and flat year over year.
Flat year over year, even with growth. Did they mention staffing?
Yeah, they said they actually increased their employee count by 5% over the year.
So headcount up 5%, but expenses flat. That implies some decent cost control or maybe investment timing?
Seems like it. Management guided for non-interest expense to be in the $46 to $46.5 million range per quarter for the rest of the year.
But with a caveat, I assume.
Right. They said that could fluctuate, especially depending on those expansion efforts we talked about.
Makes sense. Okay, wrapping up the numbers. Capital and taxes.
Capital looks solid.
Yeah.
Well capitalized. Common Equity Tier 1 ratio is 11.4%. Total risk-based capital at 12.9%.
Comfortable buffers there. Tax rate.
The effective tax rate increased to around 20%, and they expect it to stay around that level for the rest of the year.
Okay. And any management changes announced?
Just one mentioned. The chief credit officer is transitioning out of the role soon.
Oh, okay. Is it abrupt?
Doesn't sound like it. They said he'll stay on in a consulting role for a while to ensure a smooth handover.
Okay, good for continuity. Right, let's try to synthesize this for investors. What are the key takeaways here?
Well, first off, the strong loan and deposit growth really signals positive business momentum, right? Things seem to be clicking operationally.
Yeah, that top-line growth is hard to ignore.
Then there's the credit piece. The slight uptick in charge-offs. Management presented it as normalization, getting back to pre-pandemic levels.
So not necessarily a red flag, more like resetting expectations.
That seems to be the message. The increase in non-performing assets is worth noting. But the fact it's tied mainly to two specific situations might limit the concern about broader portfolio issues. For now, at least.
Okay. What else? The cash balance.
Right, that big pile of cash at the Fed. It's dragging on the margin currently, but the expectation is that it gets deployed or normalizes.
Which could provide a lift to the NIM later on.
Exactly. And don't forget that asset repricing potential over the next year, nearly $2 billion. That's a significant tailwind if rates stay elevated or go higher.
Also, management's commentary about focusing on organic growth and keeping expenses in check. That's usually well received.
Definitely. And the discussion around deposits, that influx of municipal money potentially flowing back out, gives you a heads up about near-term balance sheet shifts.
What about their comments on the economy? Anything specific?
They sounded pretty resilient about their Main Street business customers, seeing strength there despite wider economic worries.
Interesting perspective from the ground level.
And they also specifically mentioned not seeing much impact from tariffs on their clients, which is another data point on those broader macro concerns.
Okay, lots to chew on there. Now, as we always do, this is absolutely not financial advice.
Definitely not. Just some creative thinking.
Let's brainstorm some outrageous but plausible trade ideas based only on what we heard in this call. Just for fun, get the wheels turning. You got one.
Okay, here's one. Consider the big jump in cash at the Fed, right? And the expectation that some of those municipal deposits might flow out. That creates a need or an opportunity to deploy liquidity, yeah.
Right. They won't want that cash just sitting there indefinitely.
So maybe, just maybe,
Yeah.
You can think about a long position in a high-quality short-duration bond fund. The idea being the company might strategically park some of that excess cash there to get some yield without taking on huge risk while they figure out longer-term deployment.
Speculating on how they manage their own treasury operations based on deposit flows. Interesting, plausible, if a bit indirect.
It's based on them optimizing that cash pile when those municipal flows change.
Okay, your turn. Outrageous idea number 2.
All right, sticking with the growth theme. They talked about strong loan growth, broad-based, and specifically mentioned Florida opportunities, right?
Yeah.
And adding producers. Also some comments maybe about senior housing healing a bit.
Yeah, those points were made. So, super speculative idea. Maybe a targeted long position in a small publicly traded real estate company that's heavily focused on, say, the Florida senior housing market.
Whoa, okay. Connecting the bank's general optimism and market focus to a specific niche property type in that state.
Exactly. It's high risk, high reward. You're betting that the bank's positive view reflects a genuine underlying recovery or opportunity in that specific segment and region, and that this smaller company would benefit disproportionately.
That's definitely leaning into the outrageous side.
Yeah.
But I see the logic trail based on the call commentary. You're betting on a localized trend they hinted at.
Pure speculation, of course.
Okay, let's wrap this up.
So summarizing the call, a solid start to the year overall. Strong growth in loans and deposits.
But balanced by some margin pressure from that excess cash and credit metrics sort of normalizing, maybe a bit higher than recent lows.
Management sounded pretty optimistic about the rest of the year, though. Focus remains on organic growth and managing those costs. As always, remember, this is just our take on the call. Any investment decisions you make should be based on your own thorough research and your comfort level with risk.
Absolutely. We definitely encourage you to dig into the full transcript, the filings, get the complete picture for yourself.
So what stood out most to you from this deep dive? Any questions we didn't quite answer? We genuinely love to hear your thoughts.